Hello, everybody. My name is Jerry Kronenberg of Moomoo Technologies, Inc., and I'd like to welcome you to our latest and greatest live chat, Catching the Wave for the rest of 2023 and beyond. I'm joined today by two great guests to talk about the markets. Joining us via Zoom is Rob Isbitts, founder of ETFyourself.com. Rob is a frequent writer for Forbes.com, Seeking Alpha, and ETF.com. He is a two-time author and a three-time mutual fund manager, and he has been charting stocks since 1980 when he was just 16 years old. Rob, welcome. Good to see you. And here in the studio is our own Justin Zacks. Justin is our own vice president for strategy, and a very good one at that. Justin, welcome.
Great to be here.
Well, I'd like to remind everybody this is a live stream and we'd like you to participate. So please go ahead and use the live chat function to ask your questions. If you do submit a question, you will be rewarded with 75 Moomoo points, or Moo points, I should say. And if we mention it on air, you will get 150 Moo points altogether. However, please do be advised that we cannot give personalized advice. And so our guests will only give answers of a general nature and not hard buy, sell, hold recommendations. Let's get right to it. We have some questions that we've already received before we went live. And let's start with the first one for Rob. Rob, this one comes from user Kin8858, if I'm pronouncing that correctly. There's a mixed opinion about a recession and a peak in the year to come, that is 2024. What do you think will happen, and how sure are you? What do you think, Rob? Recession, no recession, peak of the markets, where are we in the cycle?
Sure. Thanks for inviting me, Jerry, and great to be here with you and Justin. I'm going to answer that question, but first, here's I think a quick statement to help everybody understand kind of where all my opinions come from. I think it'd be helpful for background. I summarize investing this way: any security or market index can go up in value at any time, and the difference between different parts of the market and any point in the market cycle is how much risk of major loss is attached to the pursuit of that return. So it's all about how much risk is attached to the return that you are going after. And the same thing goes for evaluating the economy, that same reward risk trade-off. So now to the specific question that the user asked. So I think it's fair to say that Europe is essentially in recession. Asia is probably in recession, certainly China. And I think the U.S. is too, but here's the thing. It isn't so much in our faces that the market is freaking out about it right now. And so I think 2024 is when some of the lagging effects of 11, count them, 11 Fed rate hikes on the U.S. economy start to really pinch. We started to see how that has affected some different areas of the economy and the markets, and even a little bit of employment now. But we've really yet to see how much the market cares about it. So, I think that's where I stand. I will say this also. I like the end of that question. How sure are you? Because that's where I think a lot of investors get in trouble. And I read and listen to all the chatter about recession, inflation, what the Fed will do, et cetera. But like you said, I've been a technician since my late father, pictured back there, who watches the market with me every day, taught me when I was 16 years old back in 1980. Back then it was graph, pencil, and paper. Today the markets have changed so much. Even though I take mental notes continuously on all that stuff, I know that ultimately the headlines and the actual economic data, even like the CPI out this morning, it doesn't matter as much as this. What matters is the price of your investments after you buy them and until you sell them. So to me, summing up the answer to this question, the best way to look at the economy in 2024 is this: invest and trade based on what actually matters. What actually matters is price. And don't let the so-called narratives from all the market gurus distract you.
Great. Excellent. Thank you. And Justin, what do you think? Recession or no? Market peak or no? What are you looking for 2024?
So I would have to agree with Rob here. It's really about a probability, right? Like no one can predict 100% there's going to be a recession or not. But I think about it in these terms. If you look back last year about this time, economists were probably more likely to predict a recession in 2023 than they are now predicting in 2024, despite what we see, some slowing economic conditions, some rising unemployment. So that, to me, that's very interesting. So people think there's less of a chance, even though some of the numbers say there might be more of a chance. Meanwhile, the S&P 500's up over 20% this year. So not only do you have to look at where the market is and look at where it's come from, right? So last year, so the idea of a soft landing seems to be more priced in than it was last year at this time. So if you don't see that narrative, you will see the markets be at risk. And certainly we need some type of soft landing for this, continued rise in the price to continue into 2024. Something that deviates from that era would likely see a price decrease. And as Rob said, it's really all about the price and where the valuations are compared to where they were in the past. And I'll just give you, I just looked recently. Last year at this time, trailing multiples were about 17 and a half. Now they're about 21 and a half. So there's less room for error. And so that makes it a little bit more difficult to say, I want to be long in a recession or not, because you can have a recession and prices can go up. And it's happened before during recessions, but you can also have major crashes during those periods. So it's all about the probability of that happen. No one can predict for sure, but you really want to think about what's more than likely to happen.
Absolutely right. Just one thing
Sure.
I'd love to add to what Justin just said. This is analogous to looking at a stock and saying, what is fair value? And is it priced at fair value, or is it above or below? It's almost never priced at fair value. And the market is the same way. And so just like Justin was saying, you could get a recession, or you could get a soft landing or a hard landing. At the end of the day, it's whether or not the market puts value on it. And, the market players have changed so much over the years. Indexation, I do a lot of work in ETFs, so I'm quite familiar with that. There are a lot of elements, trading elements, et cetera, that make the markets move differently and what the market rewards differently. And frankly, if you're old school, or if you're new school, you kind of have to learn how the other part thinks, because that's what makes a market. And a lot of times I think people just stick with a narrow view. This is going to happen. And I think you folks would agree, investing is rarely an all or nothing proposition. Like you said, Justin, it's a trade-off.
Well, that's great. I'm going to throw in my own personal view, which is that the indicators may weaken, which would technically be the economy in receding. But I'm thinking, at least in the first half, just the feel you get in the economy is that unemployment is still excellently low, jobs are plentiful, people are putting money in 401ks. So I don't see any sort of market crash. See what happens, at least for the first half, just my view there. And let's go on to our next question. Again, I would encourage people to ask questions in the live chat. We are getting some, and we'll get to them, but we'll go with a question that we got before we started. And this is from Meme Short Queen. And we'll start again with Rob. Do you think value stocks and or the Russell 2000 will catch up or even outshine the Nasdaq and the S&P 500 in 2024? And if so, why or why not? Great question. Rob, what do you think about that?
Well, first of all, really like the screen name,
Me too.
Meme Short Queen. Let's break this out a little bit more. So when we look at large cap stocks, it's really FANG and everything else. And I think FANG underperforms in 2024. By how much? Depends on whether 2024 is a lot more like the year 2000. And I'll talk about that perhaps a little bit more. If it's not like 2000, then, FANG can fall like it did in 2022 and then some. If it's not, it could be a case where, kind of like you just said, Jerry, the first part of the year, there's at least a realistic possibility of a melt up driven by what's already working. This is how business and market cycles often crescendo. But keep in mind, if that happens, it's usually the last phase. Now, on Russell 2000 and small caps, let's be careful here because the Russell 2000 as a small cap indicator is full of a lot of zombie companies, as we call them. They're only still around because they can borrow money and stay afloat. Well, guess what starts in 2024? A historically high refinancing wall. It runs 24, 25, and into 26. And during that time, a lot of debt that was issued by small cap companies at much lower interest rates now has to be refinanced. Imagine being a CFO of a small company who's fighting for survival, and you're replacing your bonds that used to yield you're paying out 4%, and maybe now you're paying double. I mean, that just doubled your interest costs in that example. So the U.S. government has the same problem. However, they have a printing press. Small cap companies don't have a printing press. So on the flip side of that, though, and again, this is where I think it comes out of a lot of my ETF work. The smaller companies that are healthy and cheap and have, let's call it cash cow nature, strong cash flow, low PE, earnings that are fairly predictable. Maybe they pay a decent dividend, but they don't have to. But these cash cow small caps, I think, probably are the best shot at a small cap rally continuing beyond a matter of weeks or a couple of months. I think also, just to finish addressing the rest of that question, I think the Dow outperforms the Nasdaq and the S&P in 2024. Why? That same stability quality issue, or at least the perception of, because perception is all that really matters ultimately to price. Do this. I would welcome everybody in the audience to try this on their own. Go and pick a software system. Maybe you can do this on Moomoo. That would be great. But create a blend, and then compare it to having 100% in the S&P 500. If you look back over the last 5 years, I dare you to be able to tell the difference between a third Nasdaq, 2/3 Dow, and 100% S&P. And that has everything to do with the fact that the S&P has basically been infiltrated so much by the big Nasdaq stocks. It's not a market indicator as much as it is a mega cap stock indicator. I'm talking about the S&P now. 7 stocks make up 30% of the S&P, and the influence those 7 stocks have on their peers, I think, goes even greater than the 30%, on paper. So a lot of the S&P really does sort of go through what happens with those stocks and some of their peers. And frankly, that's why, at least in my equity research, I'm still a really big fan of researching, analyzing, and figuring out ways to deploy the 30 Dow stocks. There's a lot you can do with that little watch list of companies that are kind of clear long-term leaders. Obviously, you have to determine whether they're right value, et cetera. But so I'm Dow over S&P and S&P over Nasdaq because of the interrelation between them.
Great. And Justin, what's your take on that? Small caps, Russell 2000 or Nasdaq/S&P?
So yeah, I looked at this exact thing a couple weeks ago. So this is, looking at data as of the end of November. I'm going to give you a few statistics.
And this was unrehearsed, wasn't it? We got to the same place without actually talking about it until we were live. That's great.
Yeah. So the Magnificent Seven, those top 7 stocks were up 99%. Compared to the Russell 2000, up less than 3%, to give you an idea. And there's a question of growth at any price. At some point, right, you can't say these stocks will continue to go up and beat every other stock forever. At some point, there has to be a retracement, and people say, the future cash flows are not worth the price I'm paying at this point. And you look at the rally we've had this year, it's been relatively narrow. The S&P 500, only 27% of the S&P 500 is above, has returns above that 19% level as of the end of November. So that usually that number is about 51%. So that's a very narrow rally. And again, I said it's been driven by the Magnificent Seven. Very interesting. Look at yesterday. Every single Magnificent Seven stock was down. The average down 1.45%. The Nasdaq 100 was up 0.85%. Maybe some of this had to do with the Nasdaq rebalancing that was, came out Friday evening. But it's, you do see some of those reversals. So it's something to be aware of. The real question will be, will these, if it happens, will these value stocks come up and meet the Magnificent Seven, or will the Magnificent Seven come down to meet the value stocks? And I think a lot of that will depend upon how investors feel, the outlook for recession and the outlook for inflation. We just had these inflation numbers, and you see core CPI still at 4%. And, we haven't seen core, CPI before this little run, probably back into the early 90s. So it's still kind of hot. Like, as much as it's come down this year, it's still, core is still nowhere near that 2% level the Fed's looking for. And that's something I'm definitely watching at this point.
Yeah, that's great. Oh, sorry, Rob, did you want to?
I think that's where the expression "price for perfection" comes from on Wall Street, right? That would be a good way to describe those stocks.
Right. I think that those have got some very high both forward and trailing PDEs, and we'll see how long that can go on, but presumably it doesn't go on forever. Next question is from a user with a number that I can't read, but excellent question. Will there be a major market correction in 2024? Rob, what's your take on this?
Sure. Well, here's, I think, where I get to go back into history a little bit, not because I want to bore people with history, but because there is some specific history that I think that a lot of, let's say, more recently indoctrinated market participants should understand. And so I'll try to give the very short introduction to it here, and so folks can go and research on their own, because it's easy to find this stuff. So first, when we talk about corrections, I mean, major is really in the eyes of the investor. I can tell you what I think. Keep in mind, my first rule of investing is avoid big loss, ABL as I call it. And big, for me, starts around 5 to 10% on an individual trade, 15 to 20% on a broad market decline, and we get those every couple of years. As for next year, 2024, I think we are clearly set up for a significant decline in the broad stock market, in part because what have we had the last 2 years? We had a steep decline, and then everybody forgot about it in 2023, and everything looks fine. But in reality, we're going on 2.5, almost 3 years of, as they say in New York, gots, nothing. Okay, so I think that the longer that stagnation goes on, that in itself can be a frustrating thing for people with T-bill rates still sitting, in the high 4s. However, I think markets do work differently today. There's still buy the dip, and as long as that habit persists, there is if you will, a cradle or a net under the market. And so much attention, as we just talked about with the FANG stocks, so much tension is on just a few corners of the investment market. And so the S&P, yeah, it's up 17%, that we said, but the average stock in the Russell 1000, okay, average stock in the Russell 1000. There's an ETF for everything, by the way, and so it seems. But there is one for that, and I use it as a market gauge, not so much for investment. Over the last I believe 2.5 years, the average stock of the top 1,000 is right about flat, maybe slightly down, and that's including dividends. So, there are a lot of sectors and industries that have had major declines, but the top-heavy nature of the market and the popular indexes kind of hides it. So, yeah, I do think that there's going to be a major correction in 2024. In fact, now let me, if you don't mind, I get to those three historic parallels because, like they say, history doesn't repeat, but it rhymes. Okay. So the first is the year 2000. And so let's say this plays out something akin to what we saw in 2000. I alluded to this earlier. So what would happen in that case? It would rise sharper and faster than anybody can imagine. And that would be that final blow off top of this post-pandemic era. In 2000, that year started with 9 weeks of bliss and then 3 years of losses in the S&P and the Nasdaq. The S&P only fell 9% that year because it got off to such a strong start, but then it fell 13% the next year, 22% in 2002, and a little bit in 2003 before finally recovering. Those were early in my investment management days, so I remember them very well, having to make decisions through that environment. That's kind of the slow bleed version of a correction or worse. And the thing is, the dip buyers would get crushed every time. It's already happening in parts of the market, what we call in technicians, lower lows and lower highs. That's one scenario. But again, you had the sharp rally for 9 weeks, and then the last 9 months of 2000 fell, not a typo, 50%, okay, from its all-time high. So that's why I think knowing the history, especially from folks like me who've experienced it firsthand in the hot seat, can be helpful. So that's one, the year 2000. The second is 2008. People know 2008. There's been movies about it, et cetera. We had this regional banking crisis, which to me maybe look back in history as this generation's Bear Stearns. There was Bear Stearns. Everybody said, okay, we recovered from that. Everything's fine. And then 2008 was Lehman, and it just got worse from there. Investment, the banking business was a mess. The consumer fell down. Real estate woes. I mean, does this sound familiar? That was a 37% drop in 2008 in the S&P 500. But I know something worse. How about a 55% decline in 7 months? When I started managing my first mutual fund, the inception date of our fund back then, a long time ago, was August 14th of 08. Any market history buffs know that that was about the worst time to launch a fund, not that we knew. 55% decline from August of 08 to March of 2009. I used to call it the welcome to the show, kid era, like getting called up to the major leagues and finding out that it's a lot tougher up there. I survived. So there's 2000, there's 2008, and then there's one other. And it's one that a lot of people don't remember, and that's 2010. And this is frankly the more optimistic of the three. The 2010 was after you had that vicious decline in 08, and then a big rebound, 26% for the S&P in 09. The S&P gained another 15% in 2010, but it was a back and forth year, a lot like this past year. The entire return, the whole like 15% for the year, was in the last 4 months. And I was going to say, if the market feels anything like that after this year, that would be it. So I think there's the 2000 scenario, there's the 2008 scenario, there's the 2010 scenario, and of course there's the obvious fourth one, which is none of the above. And we'll know as the year proceeds.
Justin, what do you think? Major market correction?
So, my thought, again, going back to the probability, no one can predict whether there'll be a major market meltdown. My thought is the way we are set up right now, there is a higher likelihood than there is on average that you could see a crash. But there's going to have to be some type of catalyst that drives it there, right? So, right now everything's priced for a perfect landing and rates are coming down. And my thought is a lot of this is going to depend on those rates. So next year, the federal government is going to have to refinance a huge amount of their debt. And my question will be, is there going to be the buyers for that debt? And if there's not, you could see long-term rates rise even as the economy slows, this would be a generally a bad situation for the markets. And depending how much, that economy slows, even if rates come in, it could be for the wrong reason there. And what I would really be tracking is this Magnificent Seven. My thought is if the Magnificent Seven can't hold on to its gains, that will set up, a correction. But if they can, and if AI truly is able to continually increase their margins and boost their profits significantly beyond what people think right now, maybe they can hold on to those gains, and you might not see any type of corrections. But I would be watching those Magnificent Seven stocks, their earnings, how they do, their outlook as well for growth. Are they going to continue to predict this astronomical growth that we've seen out of them recently? And if that can hold up, I think we'll do well. But if not, that could be one of the catalysts that could set the market up for a downturn.
Like a game of chess, huh?
Yeah.
The game's not over until you get the king, and the Mag 7 are kind of like the king.
It's true. All right, running low on time, but let's finish out with a question about Tesla. Tesla's constant lowering of prices. Will that push out its market share, and I'm paraphrasing here, of its competitors? Will it gain market share from its competitors from lowering prices? Rob, what's your take on that?
Well, I am much more a technician than a fundamental analyst, but I would say this. There's an old joke, I think, from the Catskill region of New York from back in the day, or the vaudeville days, and they say, well, it's okay that we're losing money on every car we sell because we'll make it up in volume. Well, you're still losing money. So I think that is really the Tesla story. But once again, going back about 25 minutes ago to where we started this conversation, there's one thing, the facts are one thing, and the fundamentals are one thing, but what ultimately matters is, where's price going? And with all of that news, look, Tesla has been in what I would call a very subtle, soft, almost can't notice it downtrend, and it's toward the top of that trend. It's been in that range, as I'm looking at the chart here, through really since July. But this is what we call no man's land, where you don't know if it's going to break out and fly or not. And I will say this: I wonder if the ultimate fate of Tesla, the stock, has that much to do with the ultimate fate of Tesla, the business, because I don't think up until this point that one has been kind of reflective of the other.
Well, that's a good point. And Justin, your take?
My thought is really something I got from Elon Musk on the last conference call. He talked about the interest rates. And if you look how the stock's done since interest rates have come off, the stock has gone back up. And it's really about not necessarily just the overall cost of a price, but most people will finance their purchase of a car. And so you're really looking at the payment, and the payment is going to depend upon that interest rate as well as the credit worthiness of the buyer. And that's what I would be focused on for Tesla and its ability to hold pricing, as well as all the car makers. If we see rates continually increasing, it's not going to be a good situation for any of the car makers.
Yeah, Jerry, I know we're short on time. But I would hate to get through half an hour of talking and not remind people, as kind of what Justin just leaned into. In the U.S., the consumer is at least 70% of the economy, and so as we're talking about the Mag 7, but it's really what happens to the fate of the consumer. And last I checked, there's about 1.1 trillion in credit card debt, and at least the rate on is only about 22%. You know what I mean?
That is a concern. All right, we could talk about this all day, but we are running out of time. So Rob Isbitts, founder of ETFyourself.com, and Justin Zacks of Moomoo Moomoo Technologies, Inc. Thanks for joining us. My name is Jerry Kronenberg For the best news and commentary on the markets, check out the Moomoo app 24/7. Thanks for watching and happy trading. Thanks, everybody. Take care.